People who are here for the third Thursday webinar on energy subsidies. This is Bruce Bewald. I'm the CEO of Synapse Energy Economics, and I'm happy to have Doug Koplow, founder of EarthTrack, here with us for this webinar. Just a few logistical things. You are going to be on mute, so everyone is on mute except for our speaker, but you can still ask questions. You should email questions to webinar, plural, singular, webinar@synapse-energy.com, and if you send us questions, we will pose them to Doug. Also, now's a good time to mark your calendar for next month, third Thursday of June. So it's June 20th, 2 o'clock. We don't have a topic yet, so feel free to suggest topics or volunteer to present if you think you'd have something interesting to talk about. Anyway, I guess that's it for introductions. Take it away, Doug Koplow.
Thanks very much, Bruce. It's great to be with you this afternoon talking about energy subsidies. It's an issue that I've worked on for a long time, and I think particularly at this time when countries all over the world are working hard to try to put prices on carbon and figure out ways to reduce our carbon footprint, there's this parallel system of government intervention in markets that often offset a lot of those goals. And I think it's important to really dig in and look at this issue because it's an important lever in helping us move forward. At their most basic, subsidies involve the use of government regulation, government taxes, government risk-bearing as a way to shift benefits from the public sector to private firms or individuals or states or sectors. And there's always a little bit of marketing that has to go on in order to make this happen. There's my, not going down here. Sorry, we're having a little technical issue here.
We're trying to drive the slides.
Oh, here we go. And I love this ad. This is from 1947. For some reason, Seagrams thought it would be great to pair their product with the early days of the atomic age. But it illustrates a number of important points, that you've got these technologies you want to convince the public to kind of sign on with you and contribute their resources. You can do great things. You can make the deserts bloom if just you contribute your support to it. But one needs to kind of take a cynical view of it and step back, because dreams are always better if you're spending someone else's money. And you need to ask questions like, whose dream is this? How is it going to serve the public? How quickly are we going to get public benefits? Are we giving up important things by putting our resources in this particular area? Can we even measure if we're successful? And are we going to create new problems that we haven't really thought about if we do this? And on this last point, I think government support for ethanol and biodiesel is a good example. It was a reasonable idea when there were not very much production, but once you started to scale it to feed the auto fleets of the United States or Europe, you had a lot of land issues and competition for food, deforestation in Southeast Asia and so on. So really, subsidies are often about political power. They are about redirecting benefits to specific interests. And this dynamic has been going on for a very long time. This slide talks about Joint Committee on Taxation, which even today tracks tax expenditures. But it's an investigation that they did in 1927 of a then still pretty new subsidy, the percentage depletion allowance for oil and gas. And they were concerned that maybe that it was helping different groups in inappropriate ways. There's a great quote in an article that was done about 5 years ago about how the particular decisions were reached. The senator who supported it said we could have taken a 5 or a 10% figure on what we could deplete, but we grabbed 27.5% because we were not only hogs, but the odd figure made it appear as though it was scientifically arrived at. So this type of dynamic of presenting things as being somewhat different than what they are remains in play today. But the subsidies matter a lot. They act as negative taxes. They often support environmentally damaging activities, and they can create competitive impediments to the cleaner substitutes and other greenhouse gas reduction strategies that we're trying to achieve through other policies. It also takes money, and this can divert limited public funding from key social objectives. It's an issue in the United States, but as I'll talk about later, it's a very big issue in many other countries. And also, the scope and scale of subsidies is often hidden. There are lots of ways that governments can transfer value to private parties. It can come through many different government agencies and many different levels of government. And in too many cases, the recipient firm is the only one that really knows the full picture of all of the supports that they're receiving.
Excuse me, Doug. Can you give us any examples for that point of subsidies being known mainly to the recipient of the subsidies? And if you're going to get to it later, that's fine. But do you have any specific examples where that's particularly?
Well, there's a lot of information that's fragmented. So you'll have federal tax breaks, you'll have state and local supports, and maybe reductions in property taxes. It may be support for hiring people or for plant siting, and maybe getting a whole array of different loan supports. So in each of the cases, there may be people that know what's going on, but it's very difficult to pull together all the individual crumbs and see what the total size of the support is. This table here, I think, provides a good example of why. When many people think about subsidies, mostly they think about cash payments from governments to individuals or firms. And direct spending certainly is an important mechanism that's used to support different activities, but it's one of many, and many of the other ones are quite a good deal more complex. So tax expenditures involve special changes in tax rules that not everyone gets. That can reduce the taxes you pay or give you credit or give you time value benefits because you get to delay your payments. Governments are active in natural resource leasing all around the world, and there can be complex issues associated with how they do that leasing, whether there are enough bidders, are they getting breaks on the royalties or breaks on the terms that result in the public not realizing the full benefit of what's being sold. In financial markets, credit subsidies in terms of loans or loan guarantees are extremely common. And on the risk side, if there are particular activities that create important operating or accident risks, governments may provide insurance programs and charge premiums that are too low to cover the risk, or they may have statutes that simply cap the amount that needs to be insured at levels that are below the damages that can be expected. Induced transfers is kind of an interesting term. It's basically government rules that force people or firms to buy stuff at higher or lower prices than they would willingly do so on their own. So renewable portfolio standards would fit into this, price controls, tariffs, or import or export restrictions. And then you've got regulatory exemptions. You can have externalities where some forms of energy create a lot more health and environmental problems than others, and if they're not paying for it, their prices will be artificially low. And this last category, state-owned enterprises, really cuts across everything else. So according to OECD, roughly 70% of oil and gas reserves and related infrastructure are owned by government entities, not by private entities. And those entities can have preferred taxes or pay no taxes at all. They may not have to get the same type of insurance that private firms get. They may get access to markets that are based on their state ownership as opposed to market competition. and this can make it very difficult to see what the actual value of and cost of their operations is. So we have a related problem as well. That is that the types of subsidies that flow to different forms of energy aren't always the same. It just so happens that for renewables, such as solar and wind, the biggest forms of support they receive in the United States are also pretty easy to see and pretty easy to quantify. So tax credits, accelerated depreciation, renewable portfolio standards, and so on. Whereas with fossil fuels, there's pretty complicated stuff going on with leasing, multinational corporate structures that allow reduction or avoidance of tax. There's a bunch of energy security and stockpiling issues that apply to oil and not to other resources, and so on. So you have a situation where it's easier to see the subsidies to solar and wind, harder to see the ones for fossil fuels, and that does create some political challenges as a result. There's also a political side of this. If you receive significant subsidies from the government, political economy says that you will invest a certain portion of that to protect or expand what you're getting. And we can see that that does happen in the United States. This is just a snapshot of the budgets of a number of different organizations. The American Petroleum Institute is the largest oil and gas trade association in the U.S., and they have a budget of almost $250 million, which is much larger than even the largest environmental groups in the country. And those environmental groups aren't just focusing on energy. There's also a pushback on subsidy definitions that's quite common. So the quote at the top is the tax policy lead from API, who's basically saying that even the most basic tax breaks to oil and gas that are widely recognized in the government studies and widely recognized in international analysis of fossil fuel subsidies aren't really subsidies, and there's no problem there. Now, obviously, you can contest these claims and push back on them, but there's a certain subset of the population that takes them at face value, and that makes it difficult to move forward with challenging them and reforming them. So I want to talk a little bit about how big these subsidies are. There are three main organizations that try to track subsidies on a global basis, and that's what this chart summarizes. The International Energy Agency, its sister organization, OECD, and then the International Monetary Fund. A few important things about this slide. First of all, the ways that they measure subsidies is not exactly the same. IEA uses an approach called the price gap. They take a reference price for a particular fuel and compare it to how much it sells for in the local markets, and then they see if it's selling below the world price and calculate that subsidy. OECD looks at individual interventions on both the consumer side and the producer side and tries to value how much they're worth to producers and consumers, and they also pick up an incremental price gap. So they include IEA's assessment plus more. It may seem confusing, therefore, that their estimate for fossil fuels is lower, but it's because they're actually covering different countries. OECD is picking up the world's larger, wealthier economies. IEA is picking up more developing countries. And so for a reasonable estimate, you can almost add the two of them together to get around $440 billion a year in fossil fuel subsidies. There's a little bit of overlap, but that estimate isn't too bad. The International Monetary Fund looks at the problem differently. They say, oh, all these subsidies are important, but there's all this stuff going on the externality side. We've got a lot of air pollution. We've got climate change we want to take account of. They also include some of the impacts on traffic and motor vehicle accidents, which there's a little bit more disagreement across the international community on how those should be counted. But their numbers are an order of magnitude larger. So this value for 2017 is $5.2 trillion, more than 6% of global GDP. Even the lower estimates from IEA and OECD are still a significant amount of money and share of global GDP. So there's a lot of opportunity here. If you could reform and redirect these things, not only would you get better price signals in your fossil fuel markets, but you would also provide additional government resources to use in different ways. Another interesting aspect of this slide to me is that there are no estimates, no global estimates done by anybody on subsidies to nuclear power. And nuclear energy is often put forth as the key solution to deal with climate change. They've had a lot of challenges on cost, not just in the United States, but other places around the world. And they have received significant subsidies for many years since their inception. And if they are going to play a big role, I would very much like to see better data on the subsidies.
Question, Doug. This table has biofuels broken out. Is there a reason for that?
There is. Part of it is that the IEA likes to separate the electric sector from others. The other one is that in my mind, biofuels is sort of renewable. There have been a lot of environmental problems as it's scaled, so I don't like to see it lumped in with other renewables. But it's useful to note that even in 2017, with fairly rapid growth in renewable subsidies around the world over the last 10 years, renewables still receive less than half of what fossil fuels were getting, according to the IEA estimates. I think that's interesting. Also notable that most of those subsidies were feed-in tariffs abroad in renewable portfolio standards in the U.S. And Europe and many other countries are going to competitive tendering of the renewable contracts, which has the result of greatly reducing the price premium on the renewable power that they're getting. And that has also, some key ones in the U.S., like the production tax credit for wind is phasing out as well. So I would expect to see that number actually declining in the future despite growth in the industry.
So could you stick on this slide for just another minute and kind of comment overall? As you walked us through this, Doug, I felt like I was reading between the lines of which of these, as analysts, you agree with or disagree with a little bit, or kind of strengths and weaknesses. But can you kind of step back and say, kind of on the whole, is one of these columns more reasonable than the others, or kind of, what's your take overall on, given these different studies and their limitations and focus? What's your opinion?
So I guess my opinion is that I think in terms of fiscal subsidies, excluding externalities, it would be reasonable to add together the IEA and OECD numbers as a ballpark for subsidies to global fossil fuels. They're actually working on doing that now and doing it in a more refined way. So they're not going to come up exactly with $443 billion a year, but that's a reasonable estimate. That said, I have some issues on the IMF's inclusion of some of these transport sector issues, but I absolutely believe it's critical to integrate negative externalities, particularly associated with coal. And so I'm very glad that they're doing that. And this is their third round doing it. Each time they do it, they're doing it with more precision. So I think it's a really important contribution that they're making.
And my last question on this slide is, this is for 1 year, a snapshot. And I don't know if you have a sense of whether, what's kind of the trend over time? Are the subsidies growing or shrinking, or is it more complicated than that?
That's a really important question. The multi-year data, they don't have this going back that far, but the multi-year data shows the subsidies rising with oil prices and then starting to decline again around 2014 when the prices dropped again. This happens because they're doing a very good job capturing subsidies to consumers. Governments are under more pressure to provide subsidies to consumers when the price of oil and gas is high. And one question that IEA and OECD always ask is, when they're observing a decline in the overall subsidies now, is it permanent? or is it just an artifact? So if the governments haven't actually reformed the way they provide subsidies so that it stays low, even with higher prices, these things will rebound as oil prices rise again.
Sorry, one more question from the phone is whether the IMF post-tax estimate has social cost of greenhouse gases.
It does. It does.
For the fossil fuels, that's
yes.
why it's separate.
Well, they also, yes, but they have a lot of work that they've done on air pollution as well, and that would be separate.
Thanks.
And the IMF is breaking them out by externality type, so you can go on their website and you can see the contribution of each of their externality types.
Thanks.
So I mentioned earlier about the opportunity cost of these subsidies, and this table tries to quantify it a little bit using data from IEA. As I mentioned, the IEA data capture many more developing countries where there's fairly high levels of poverty. In column 1 shows that 6 of their 37 countries in their sample spend more than 10% of their GDP subsidizing oil and gas consumption, which is really a pretty significant number, 1/6. 22 of the 38 are spending more than 10% of their federal revenues subsidizing oil and gas consumption. And the one that really draws this whole issue out is column 3, where nearly half of the countries that IEA tracks spent more subsidizing oil and gas consumption than they spent on public health. So there's a lot of losses to human welfare that happen here. People might argue that, well, some of the energy subsidies are helping the poor as well. That's absolutely true. Some of it does help reduce the cost of key things that the lowest quintiles of income need. But the studies that have been done suggest not that much. So if you're very poor, you certainly don't own a car. Your housing footprint is much smaller. You're cooking oftentimes with biomass and dung, not with fossil fuels. And so, yes, you are getting some benefit, but most of it is going to the wealthier groups in society, and that's a problem. But because the poor still do benefit, it's really important to plan any transition to make sure that when you get rid of subsidies, you're not making their situation even worse. So we've got these big numbers and big impacts, and sort of the irony here is that even with that, we're not doing such a great job capturing all the different ways that governments subsidize energy. This chart is one view on it. It's looking at the global studies, and it shows how for oil products, the studies are doing a pretty good job at least capturing most of the countries in the world, and certainly all the big oil producers and consuming nations. But when you start shifting to other fuels that are less widely traded and have not quite as much pricing data, the numbers drop pretty quickly. And then the inventory method, which is more labor intensive, the numbers drop still further. So there's a lot of work that needs to be done in terms of expanding what we're capturing. And we can see some similar issues in the United States. This is a table that pulls together estimates from 5 different sources on how big fossil fuel subsidies are in the United States. The little smiley face in the left-hand corner is the American Petroleum Institute, because of course they're not getting any subsidies. But the next 2, EIA and the U.S. Treasury, are looking, they're the official government estimates. Treasury did a special review of this for a commitment that they did under the G20. They did a peer review process with China. And you can see that there's some issues about how it varies year to year, but also they're not all capturing exactly the same things. The federal government studies also are picking up only federal subsidies, so there's a lot of activity that happens at the state level that's not being captured in their numbers, but certainly still can distort energy markets. OECD is somewhat higher, and they are picking up subnational subsidies. And OCI is Oil Change International, which is a DC-based NGO that does a lot of work on oil and gas subsidization, and they're picking up state-level support as well, to the extent that either of them could quantify it, but also trying to expand the types of interventions that they're capturing. The issue of state subsidies is sort of a surprise to me. I had always thought that if you got the federal support, you would be picking up the most important and biggest pieces of the pie. OECD's data suggests otherwise. Their information finds about half of the total support in the United States is coming at the state level. That's significant, and it underscores the importance that if you want to deal with climate change, you really got to look at both levels of government. And then this next chart looks at three of the main studies by type of intervention. And this is also kind of a useful view on the situation. And one can see pretty quickly that the tall bars are for spending and tax expenditures. So the studies do a much better job capturing direct spending and tax breaks than they do anything else. You can see oil change picked up some of the mineral access leasing subsidies and state-owned enterprises, such as the Strategic Petroleum Reserve, which the other ones didn't. But there's all these categories that actually have no bars at all. And while I wish it's because we didn't actually provide those types of subsidies to the energy sector, that's not the case. We do provide support in pretty much all of these areas. It's just that the data is harder to get. The estimates are harder to quantify. Also instructive here is that, as noted earlier, not every type of energy relies on the same types of support. So nuclear power, for example, is heavily reliant on subsidies through credit markets, state-owned enterprises such as the Nuclear Waste Repository, and risk subsidies through Price-Anderson Act. So if you're only capturing spending and tax expenditures, almost by definition, you're going to understate the total level of government support to certain types of energy.
Doug, on this split between the state-level subsidies and the federal subsidies,
yeah,
are the state subsidies mainly land use, leasing, and mineral rights, or something else, or how does it divide it by the type of subsidy, if you have any idea?
So these are based on OECD estimates, and right now OECD is only picking up direct spending and tax breaks. So it's not leasing at all.
In either slice of that pie?
That's correct.
Okay.
That's correct. It would be great if they would be able to do it, but they haven't been able to yet. So a couple of years ago, I was talking to some colleagues at the Stockholm Environment Institute, and we were wondering if there were different ways we could try to look at government subsidies to fossil fuels. Could we combine state and federal support in a more effective way? Could we try to evaluate how all of these subsidies flow together to particular producers, or in this case, oil fields? And we came up with a study that looked at around 600 discovered but not yet producing oil fields in the United States. We looked at all across the country federal support, and then we did also integrated state-level subsidies in Texas and North Dakota. And it was a very interesting and I think useful exercise. We were able to do this because we got data from Rystad Energy. They collect field-level economic information for the oil and gas industry across the world, and we were able to use their U.S. data set. So some of the key takeaways here, that on average, the Permian Basin starting IRR, internal rate of return, was about 7.5%, and the subsidies that we looked at boosted it on average to 18.5%. So this is a very significant boost. The largest increase comes from the IDC, the intangible drilling cost, which is a federal subsidy, and that's pretty widely known as being important to the industry. But there were some surprises, like this one called road maintenance. This is a situation where fracking trucks need a lot of trips. They are very heavy. They go in with equipment. They go out with wastewater. And it turns out they were really damaging Texas roads, particularly secondary roads that weren't built to handle the weight. And Texas, to our benefit, had done a detailed look at it. So if you look at the damage they were causing, less the fees that they were paying in, there was still a pretty significant subsidy, and it provided a 25% average boost in the baseline internal rate of return. It's kind of an illustration of you got to dig into this stuff and look really carefully, because sometimes there are surprises that are subsidizing and distorting your energy markets in ways that can be really important to look at. So this next slide we looked at presents the results kind of at the field level. The bottom blue dots are what the calculated internal rate of return was with no subsidy. The gray dots are those fields with the subsidies. The boost that they get in the rate of return varies by field because the rules on every specific subsidy are not the same, and not everyone can tap into it at the same rate. One of the nice things about this approach is you're able to model that a little bit better. These orangish dots are the fields for which they were uneconomic before the subsidies, and the subsidies pushed them over and allowed the projects to reach investment hurdle rates and move forward. So we kind of divided these into two groups. The leakage zone is where taxpayer money isn't changing behavior, but rather mostly flowing to increase profits for the owners of those fields. And then the abatement zone, where the subsidies are actually unlocking large amounts of carbon emissions that otherwise wouldn't have been developed, or certainly not at that time.
Doug, can you roll the slide back to the one before this one, please?
This one?
Yeah, so what the IDC is a big item there. Can you talk more about kind of what that is, and you know, where's that money coming from, and who's it going to, and kind of what?
So this is a tax break, and we had a system at least until the 2017 tax reform. If you were investing in capital equipment or capital type expenses that lasted for more than a year, you would have to expense it over. You would have to depreciate it over time. So you would write it off your taxes as your investment was wearing out. The goal was to try to provide better information on the underlying economics. Intangible drilling costs are a whole group of things that aren't physical assets, but they actually go into the capitalization of a field in the same way that architectural drawings would for a building. And the standard mechanism would be you'd write them off over the life of the field. This allowed them to be expensed immediately, and that would create a large time value benefit for the field owners.
And these are the direct kind of financial subsidies, not the environmental, like methane leaking and things like that. It would not be included. Is that right?
That is correct. They're not included. Well, there is something called free flaring, so that's not the environmental cost, but that is if you have a publicly owned resource and you're paying royalties on it. If you get natural gas, you're often allowed to flare it and not pay royalties on it. It's a big issue across the country, but the environmental aspects of any methane leaks or other environmental issues are not being picked up here.
Okay, thanks.
So this last table tries to quantify in the aggregate our findings here, and based on the $50 per barrel long-term cost that we had assumed at that time, nearly half of U.S. discovered but undeveloped oil reserves were economic only because of subsidies. And just one side note here, we looked at undeveloped because we wanted to get the full capital cycle. So these are situations where the resources were known, the value was you know, fairly estimatable, but a well wouldn't go forward unless they could recover the full capital, not just the operating costs on it. That unlocks a significant amount of carbon, and we estimated about, so McGlade and Eakins did a very famous paper in 2015 that said if we're going to stay within a 2-degree centigrade target, where would things like oil production occur in the world based on where it's cheapest to do? And so they had an estimate for what the share would be to the United States. These subsidies would release greenhouse gases equal to about 20% of what they pegged as our available emissions from the oil production sector to 2050. So it's a big number. Now, real markets are not this simple. If the United States removes subsidies, our oil prices go up. We'll have imports coming in, so we're not going to necessarily see as large a decrease in our carbon footprint. And that is an important limitation, but on the other hand, subsidies are a global problem. So we really need to be thinking about multilateral reforms, and if we eliminate these things, not just in the U.S., but in many other countries as well, we're not going to be seeing the same degree of cheap oil flooding in as soon as we eliminate our own subsidies. So we have this parallel system that I talked about, where on the one hand, we're trying to price carbon through permits and taxes, and then on the other hand, we have a system where we're still continuing to subsidize carbon. And comparing these numbers on a global level is kind of interesting. The IEA estimated that about 11% of global energy-related CO2 was priced under some system anywhere in the world. The IMF is about 15% of greenhouse gas emissions, not exactly the same numbers, but still shows you there's still a lot of carbon not priced anywhere, and even where we do price it, we're talking about pretty low charges of around $2 to $7 per ton. And in contrast, IEA estimated that same year that 13% of global energy-related CO2 received consumption subsidies, and that the average subsidy level was about $115 per ton, of 15 times as large as the carbon pricing. So we're starting in a hole. In my view, it doesn't make any sense to just look at carbon pricing without looking at subsidies at the same time. So that's the global picture. I want to provide a few examples from the United States here, but I want to start with this whole issue of regressivity, because if you are pricing carbon, it can be regressive. We know this. Economists know this. Policymakers know this. Everybody knows it. And yet we build that recognition into our policies. We come up with solutions to make sure that the poor aren't hit when we introduce carbon charges. On the subsidy elimination side, often it comes by eliminating special tax exemptions for oil and gas. There's this huge fear that if you tax energy goods or transport fuels, it will be politically infeasible and you're going to really harm the poor. In my view, the issues are the same. Yes, there's regressivity, but we can address it through our policy design in the same way that we're doing with our carbon pricing systems. We need to do this, and we shouldn't just punt on eliminating subsidies. So now for some examples, I'll start with my home state of Massachusetts. We're doing some good stuff in this state. We've had carbon auctions for emissions from our power sectors for quite a few years now. It's bringing about $65 million a year on average. There's legislative moves to extend carbon pricing into the transport sector. The legislative proposals will start at bringing in around $475 million a year from that process, and it will rise over time. This is great. It's really important to do. But we also have different ways where we're underpricing carbon in the state at the same time. So on heat and power, we've got tax exemptions for fossil fuel energy use by residential, small commercial, and selected industrial customers. The state estimates it's $474 million in lost revenues a year. On the transport side, we don't have any sales tax on our motor fuels, and that's estimated at a revenue loss of $509 million per year. Now, roughly 10% of that is ethanol, but still you're talking about $450 million in underpricing of carbon. People contest this and say, well, Massachusetts has excise taxes on fuels, and that is absolutely true. But our total tax burden on fuels is about mid-level for the U.S., and many states actually do have both. And we also have pretty large deficits in terms of our road funding in the state, which we could fund with changes in the way we tax fuels. So even potentially having a local option tax where revenues don't just go to the state, but they go to individual towns has a lot of potential benefits to it.
Question on this, Doug.
Yeah.
So on the residential utility customer side, so are you saying that they're exempt from carbon pricing, or something else.
Sales taxes, sales and use taxes, sorry.
Thanks.
So
It looks like everything's $500 million.
I was surprised by how close the numbers were to each other, but yeah, that was interesting.
Everywhere you look.
Everywhere you look. So California is known around the world for all the work it does on greening its power supply. It's got carbon caps and pricing about 80% of its greenhouse gas emissions from its largest emitters. Seems to be doing pretty well. Carbon auction proceeds, $1.5 billion per year over the last 6 or 7 years. Very positive. But even California has subsidies to its carbon. It has a similar sales tax exemption on most delivered electricity, gas, LPG, and water. I wasn't able to break out just the fossil fuel part of it, but the total value of those together is $3.4 billion a year, which is pretty significant. They also have no severance tax on their oil and gas production, even though they're the 4th largest producer of crude oil in the U.S., and they're one of only a couple states that don't have any severance tax. And proposals to change this would bring in about $900 million a year. It's been proposed year after year after year, and politically it's been beaten down. But it's important to look at both sides of the coin here and try to figure out if we can use subsidy reform as a way to leverage what we're doing on the pricing of carbon side. And then the last state example is Pennsylvania. Like California, it's one of the few states that has zero severance tax on fossil fuel extraction. It's now the 2nd largest natural gas producer in the country, comprising 20% of U.S. production in 2017. As in California, a lot of pushback on attempts to introduce a severance tax. 2011, they introduced something called an impact fee, but the rates are pretty low. And if you added a severance tax to that impact fee so that the total tax burden was similar to what is done in similar states, it would more than double state revenues from the sector, and it would bring in a significant amount of money. So a lot of opportunities here in my view, and things that I think we should focus on. In terms of subsidies in general, the landscape is always changing. The gains here can be so big that firms and individuals are always looking for ways to leverage the government's power to tax and set market rules to their advantage. One of the particular challenges of this is that the groups that are looking to leverage these systems talk to each other. They're often the same specialized law firms or tax planning firms. And if there are innovations that they discover that seem to work in terms of how you structure a corporation or how you plan your taxes or small changes in legislation, sometimes that they help to get passed, it can trigger pretty rapid and large increases in subsidies as many of the facilities adopt the same approaches in just a few years. So some of the examples that come up: selling your closed nuclear reactor, which I'm going to talk about in the next couple slides. This issue of how you reclaim your coal mine site if you have a declining market for coal and weak financial assurance regulations. Oil and gas master limited partnerships are kind of an interesting area where there was rules that were favorable, and then over a period of about 10 years, the industry used the tax court to broaden which types of firms were allowed to form tax-exempt master limited partnerships. And then we've got new stuff going on where nuclear power plants are pushing their utility commissions in states that they're going to shut unless they get special subsidies, and pressure on the ISOs to boost the performance of coal plants in some of the auctions. So this list could be a lot longer. There's stuff that's always popping up, and it's important to keep an eye open for it. So I want to talk a little bit about this issue of selling your closed nuclear reactors. You know, as a general strategy, this isn't that unique. Isolating liabilities is a common strategy for declining business lines or firms that are under financial pressure. It can be quite beneficial to the firm's shareholders, and it can simplify business lines. But the liability and the uncertainty don't disappear. They're just being shifted. And so the question from a public policy standpoint, is that shifting good or bad? Are you bringing in specialist firms that can do a better job on this at a cheaper price? Or are you simply socializing the risk of funding shortfalls or bankruptcies or creating incentives for the new firms to cut corners? And if you guess wrong, is there any taxpayer recourse to the original utilities if it turns out that you need more money than you thought you did? So there are about 13 reactors that have done this approach with full or partial license transfers, and the strategy seems like it's quickly ramping up as reactors shut. The 6 most recent announced deals are from a firm called Holtec, and they appear to be on track to be full liability transfers, which would mean that there's not recourse to the parent companies if there are funding shortfalls, at least not at this stage of how the deals have been proposed.
And if you wanted to figure out, maybe you're going to get to that, if you wanted to figure out if these are in the public interest, these arrangements, how would one go about determining that?
So I don't have all the answers here. I'll show on the next slide after this one some of the ideas that I have. But this slide looks at the Holtec deals that really it's been just about a year. They've announced deals for 6 reactors that they're going to take over, 4.4 gigawatts of capacity, and $4 billion in nuclear decommissioning trust balances that will fund their work. I just did a simple calculation in the third column looking at how big is the trust per megawatt of capacity, and it's kind of interesting to see how much the numbers bounce around. I'm not exactly sure what it means or if it's an indicator of risk, but it's certainly something that one would want to really dig into and try to understand. So in response to Bruce's question, how would you tell if this is in the public interest or not? I kind of look at how risks and rewards are shared as an initial indicator. I have not dug into all of the deals, and one would really want to map this out more carefully than I've done. This is more of a conversation starter. But some of the potential risks that I saw, first of all, you've got a lot of accumulated capital that makes this attractive for a firm to come in and get control of the decommissioning trust. And then they're going to be billing to it. It's not that they're necessarily just managing the cleanup. They have a lot of related parties and entities that they're creating to do the work directly, and that's going to be paid for from this trust. So that's a potential conflict of interest. And one that can be problematic. They're also going to get money on the waste side. Holtec has dry storage casks, which is one of their product lines. They're working to get an interim storage facility license in New Mexico that they would potentially move the waste to. So that's an area of concern as well. And you're going from utility ownership to single asset LLC ownership on the cleanup. With a lot of cost escalation concerns. So I do worry about this. In Massachusetts, the Mass Attorney General and the NGO Pilgrim Watch have both been pushed back on the deal and are challenging it. And I think that exercise will be helpful in ending up with a better, more sustainable and stable deal structure. So I just want to conclude here on this question for subsidy reform. What are our leverage points? On the international side, there's a lot of, I think, really positive stuff happening. The main international organizations that have been working on fossil fuel subsidies for a long time are increasingly collaborating on their subsidy data collection and integration. There's much more regular reporting than, say, 10 years ago by OECD, IEA, and IMF, though there's still on the intervention side, they're still picking up mostly direct subsidies and tax breaks. There's some of the other stuff that has been challenging for them to try to capture, and I hope they will continue to work in that area. The World Bank has also been involved in fossil fuel subsidies for a long time, and their most recent push has been to build capacity in the bank to train government officials in countries that are heavily subsidizing fossil fuels on how to identify and value them, and also critically on how to plan a subsidy reform approach that protects the poor and avoids some of the negative effects in terms of riots and rollbacks that have happened in some of the countries where this has been tried. And then finally, there's an emerging role of UN environment It's the reporting lead on fossil fuel subsidies, reporting via the Sustainable Development Goals, and that should help us to build additional transparency over the years to come. Within the U.S., I think it's going to be somewhat difficult to move too much on subsidy reform at the federal level, but subsidy reform needs to be integral to carbon pricing efforts, and I do think there are many opportunities at the state level for subsidy reforms that benefit both climate and state budgets, and I would like to see those pursued. And I also think it's critical that we kind of band together to keep an eye on some of these potentially large but emerging and not yet defined new risks and potential subsidies to the energy sector, such as the sale of reactors or liabilities and dumping coal reclamation liabilities onto the public. So I appreciate your patience. I'm going to end it there, and I welcome any additional questions that you might have.
Yeah, we have just a few questions in closing. Thanks so much, Doug. Going back to the nuclear, the closed nuclear plant transfers, part of what Holtec and North Star are counting on is acquiring the decommissioning funds tax-free. And do you have an opinion of whether that those transfers should be taxable, or would you think of that as a subsidy, or haven't you thought about that?
I don't fully understand it. I think that there are private letter rulings that have already happened related to the transfer of these funds from one entity to another. And I think that in general they have been found to be tax-free, and probably they will be found to be that way in the future. A related question is, if there's money left over, who gets to keep it? The money was supposed to go back to ratepayers, and if it doesn't go back to ratepayers, that's one issue. If it does go back to ratepayers, it creates sort of perverse incentives for the company managing the decommissioning to use up the whole amount in the trust fund.
Mm-hmm. So subsidies in general, you've been focused on energy subsidies today and in most of your work over the last few decades. Do you have a sense of how it compares in energy to other industries, or energy facilities and industries particularly are they particularly greedy, and is it bigger with energy than in other industries?
That's a very difficult question, because there hasn't been that much work in lots of other industries. There's been a ton of work in agriculture, and subsidies are enormous in agriculture. In fact, a lot of OECD's work on energy stemmed from stuff that started in agriculture about 15 or 20 years earlier. Primary metals, you have significant levels of subsidization. Fisheries, that's another area that has been getting a lot of international attention because the environmental costs of it are so big. But I really can't make a judgment across all sectors.
Yeah, thanks. I've gotten the sense in talking with you and listening today that you're pretty skeptical about subsidies, right? It's mostly a negative thing, or it's about political power and pork, and these are kind of undermining. There are environmental problems associated with subsidies and so on. And I guess the question is, are there kind of legitimate, positive purposes for subsidies, and better and worse ways to do them?
I think I do come across as very negative on a lot of these things, and I think sometimes even good ideas, when they run through the political process, sometimes end up in not great structures. But I certainly support subsidies to basic research. I think there's a lot of positive benefits from doing that. I think it's appropriate to provide basic goods and services to the poor in your country, whether it's water services or energy or anything else, to keep people safe and healthy. And there are much better and much worse ways to provide subsidies. So I'll give you just a couple of examples. If you care about carbon, you want to develop systems that are neutral for how you reduce carbon. And the more your political systems and subsidies are specifically naming individual sectors and providing different rules for each of those sectors, you're going to have a politically driven and inefficient process for providing subsidies. Another important point is, can you develop rewards that only kick in if you successfully deployed something? So a renewable portfolio standard, for example, there are no subsidies unless you build a plant and that plant generates power. If you do investment tax credits, if you do loan guarantees.
All you have to do is spend money.
You just spend money. If the plant never happens, yeah, there's some legal right for the government to reclaim the money sometimes, but there'll be no corporate entity left. So all the risk is being shifted to the taxpayer, and for many reasons, I think that's a bad structure.
Well, thanks a lot, Doug. I appreciate you spending the time talking about subsidies with us today.
Happy to be here, and if anybody on the phone has questions, my email's on the slide. Feel free to contact me.
Yeah, and this webinar will be posted on the website, so a video in the next couple of days. We'll shoot you an email, let you know when it's there, so you can review things or share it, and yeah, get in touch if you have any questions or follow up. Cheers.